Before we begin, a quick and important disclaimer. This video is for educational and informational purposes only. I am not a licensed financial advisor, insurance agent, or legal professional. The information provided here is not, and should not be considered, financial or legal advice. Your personal situation is unique, so please consult with a qualified and licensed professional before making any changes to your insurance policies. Imagine this for a second. It's a Thursday afternoon. You're heading home from work, thinking about what's for dinner, maybe stuck in a bit of traffic. The rain starts coming down, making the road slick. Suddenly, the car in front of you slams on its brakes. You react, you swerve, but it's too late. Crunch. That sickening sound of metal on metal. Your heart pounds in your chest. You pull over, exchange information, and thankfully nobody's hurt. Your car, however, has seen better days. The front bumper is a wreck. But you think, okay, deep breath. This is why I pay for car insurance every single month. I'm covered. So you call your insurance company. You file the claim. The body shop gives you the estimate, $4,500. Ouch. But again, that's what insurance is for. Then you get the call from your adjuster. They're cheerful, professional. They say, great news. Your claim is approved. We'll be sending a check for $3,500 directly to the repair shop. And you just pause. You do the math in your head. Wait a minute. $3,500? The bill is $4,500. You ask, what about the other $1,000? And the adjuster says so matter-of-factly, oh, that's your deductible. You'll pay that part directly to the shop when you pick up your car. $1,000. An unexpected, unplanned $1,000 bill that you have to pay, right now, out of your own pocket, before your insurance company pays a single penny. For millions of Americans, this exact moment is the first time they truly understand what their auto insurance deductible is. And it's a brutal, gut-wrenching lesson. That one number buried in your policy documents, a number you probably clicked on in less than 10 seconds when you signed up online, is the single most powerful and most misunderstood part of your entire auto policy. It's a financial time bomb waiting in the fine print. And choosing the wrong one isn't just an inconvenience. It can be the difference between a minor hassle and a major financial crisis. But it doesn't have to be that way. Over the next few minutes, we are going to completely demystify the auto insurance deductible. I'm going to pull back the curtain and show you exactly what it is, how it really works, and most importantly, how to choose the perfect one for your life and your budget so you are never ever caught by surprise like that again. By the end of this, you will be in complete control of your policy. You'll have the confidence that you are properly protected without overpaying by a single dollar. You will be immune to that post-accident financial shock. So let's start with the absolute basics. What precisely is a deductible? Forget the confusing jargon. Here's the simplest way to think about it. Your deductible is your share of the repair bill. It's the amount of money you agree to pay out of pocket for a covered claim before your insurance coverage kicks in to pay for the rest. It's your skin in the game. It's the proof to the insurance company that you have a financial stake in protecting your vehicle, too. Let me give you a better analogy. Imagine your car insurance is a financial superhero. It's there to save you when disaster strikes. Your deductible is the price of the ticket you have to buy to get that superhero to show up. If a villain, let's say a collision, causes $10,000 in damage to your city, your car, you have to pay your entrance fee first. If your deductible is $1,000, you pay that $1,000 ticket, and then the superhero swoops in with their superpowers and takes care of the remaining $9,000. You pay the first part, they pay the rest. That's it. That's the core concept. Let's run through it with some real numbers to make it crystal clear. Let's stick with that $4,500 repair bill from our story. If you have a $500 deductible, you pay the first $500. Your insurance company pays the remaining $4,000. Your total out-of-pocket cost for the repair is $500. If you have a $1,000 deductible, you pay the first $1,000. Your insurance company pays the remaining $3,500. Your out-of-pocket cost is $1,000. If you have a $2,000 deductible, you pay the first $2,000. Your insurance company pays the remaining $2,500. Your out-of-pocket cost is $2,000. See the pattern? The deductible is the fixed amount you are responsible for. The insurance company covers the excess, up to your policy limits. And here's a critical point. If the damage is less than your deductible, your insurance pays nothing. If you have a $1,000 deductible, and you get a $700 dent in your door, filing a claim is pointless. The repair cost doesn't even meet your entry fee. You'd be paying that entire $700 yourself anyway. Now at this point you're probably thinking, okay, this is simple. I'll just choose the lowest deductible possible, a $250 or even a $0 deductible. Then I'll barely have to pay anything if I get in an accident. And that is the logical thought. But it's also the gateway to the single biggest trade-off in all of personal insurance. This is the secret handshake. This is the part you need to understand to truly be in control. Your deductible and your premium have an inverse relationship. They are on a financial seesaw. When one goes up, the other goes down. A low deductible, say $250, means you have a very low out-of-pocket cost if you have an accident. This means you are transferring more of the financial risk to the insurance company. They are on the hook for a much larger potential payout. And how do they compensate for taking on all that extra risk? They charge you a much higher premium. You pay more every single month for that peace of mind. Conversely, a high deductible, say $2,000, means you are accepting more of the financial risk yourself. You're telling the insurance company, don't worry about the small stuff. I can handle a $2,000 hit if something happens. I only need you for a catastrophic event. The insurance company loves this. Their potential payout is much smaller. So, to reward you for taking on more risk, they give you a much lower premium. You pay less every single month. This is the fundamental choice you have to make. Do you want to pay more now, in the form of higher monthly premiums, to guarantee you'll pay less later if you have a claim? Or do you want to pay less now, enjoying lower monthly premiums, by agreeing to pay more later if you have a claim? There is no single right answer. The perfect deductible for your neighbor, with their brand new SUV and 6-month emergency fund, might be a terrible, financially catastrophic choice for you. The right answer depends entirely on your personal financial situation, your risk tolerance, and the value of your vehicle. But here's where it gets even more complicated, and where almost everyone gets tripped up. You don't just have one deductible. On most standard auto policies in the United States, you actually have two. One for collision coverage and one for comprehensive coverage. And they do not have to be the same amount. Understanding the difference between these two, and setting them strategically, is the next level of mastering your auto insurance. Collision covers damage to your car from, well, a collision. Hitting another car, a tree, a guardrail, a pothole. You are at fault, you hit something, that's your collision coverage. Comprehensive, on the other hand, is for almost everything else. It's the acts of God and the weird stuff. A tree branch falls on your car during a storm. A deer jumps out in front of you. Your car is stolen. It's vandalized. A hailstorm makes it look like a golf ball. All of that is covered under comprehensive. So now you know the fundamental rule. Your deductible is the price you pay to unlock your insurance coverage. It's your agreed-upon share of the bill. You also know the critical trade-off. A higher deductible means a lower monthly payment, and a lower deductible means a higher monthly payment. But now you're faced with two deductibles to choose. How do you decide? Do you make them the same? Should one be higher than the other? How does the age and value of your car affect this decision? That is exactly what we are going to break down next. Let's imagine a driver. We'll call her Sarah. Sarah just bought a brand new SUV. It's the nicest thing she's ever owned. She's at her kitchen table, laptop open, looking at her insurance quote. And she's stuck. Right there on the screen are two drop-down menus that feel like a trap. Collision deductible. The options are $250, $500, $1,000, even $2,000. Comprehensive deductible. Same options. Her mind starts racing. If she picks a low deductible, like $500 for both, her monthly premium is $180. If she picks a high deductible, $1,000 for both, her premium drops to $145. That's a savings of $35 a month. Over a year, that's $420. That's a plane ticket. That's a new TV. That's a lot of money. But the fear creeps in. What if she gets into a bad accident the day after she signs up? She'd have to fork over $1,000 she wasn't expecting to spend. Suddenly, that $420 in savings feels like a dangerous gamble. This is the classic deductible dilemma. It's a tug-of-war between saving money now and protecting yourself from a huge bill later. And most people get it wrong because they treat both deductibles the same. They either set both to $500 or both to $1,000. But collision and comprehensive cover two very different types of risk, and they should be treated differently. To solve this, we need to introduce a concept I call your sleep at night number. This has nothing to do with your car. It has everything to do with your personal finances. Your sleep at night number is the amount of money you could pull from your bank account right now for an unexpected emergency without losing a wink of sleep over it. It's not the absolute maximum you could afford by emptying your savings and selling your stocks. It's the amount that wouldn't cause you genuine financial panic. For some people, that number is $500. For others, it might be $2,500. You need to be brutally honest with yourself. What is your number? Let's go back to Sarah. She has a healthy emergency fund. She has about $5,000 saved up. For her, a surprise $500 bill would be annoying, but she wouldn't even flinch. A surprise $1,000 bill would be more painful. She'd be upset about it, she'd have to move some money around, but it wouldn't break her. It wouldn't force her to go into debt. So, her sleep at night number is comfortably at $1,000. This is the first and most important piece of the puzzle. Your deductible should never, ever be higher than your sleep at night number. Because if it is, you're basically driving around with a ticking financial time bomb. Now that we have that number, let's look at the two coverages separately, starting with collision. Collision insurance covers damage to your car from an accident with another vehicle or an object, like a pole or a wall. Crucially, these are almost always your fault. If it's the other driver's fault, their insurance pays, and your deductible doesn't even come into play. So, collision is for when you mess up. And when you mess up in a car, the damage can be catastrophic. A minor fender bender can easily be a few $1,000s in repairs. A more serious crash could be $10,000, $15,000, even $20,000, or worse, the car could be a total loss. The potential cost of a collision claim is huge. Because the risk is so high for the insurance company, they give you a significant discount for sharing more of that risk. This is why jumping from a $500 to a $1,000 collision deductible saves Sarah $35 a month. Here's how to decide. Look at the annual savings. For Sarah, it's $420 per year. She is taking on an additional $500 of risk, the difference between the $1,000 and $500 deductible, to save $420 a year. In this scenario, if she goes just over 1 year without an at-fault accident, she has already saved enough to cover that extra risk. From that point forward, it's pure savings. Since Sarah is a safe driver and her sleep at night number is $1,000, choosing the higher $1,000 collision deductible is a smart financial bet. She's betting on herself to be a safe driver, and the odds are in her favor. But now let's talk about comprehensive. This is where the logic flips. Comprehensive insurance covers almost everything else. Theft, vandalism, fire, hitting an animal, a tree falling on your car, hail damage, a rock cracking your windshield. Notice a pattern here? These events are almost always completely out of your control. They are random acts of bad luck. And crucially, the average comprehensive claim is much, much lower than the average collision claim. A stolen catalytic converter might be a $1,500 job. A bad hailstorm might be $3,000. A cracked windshield is often just a few hundred. You're far less likely to have a $20,000 comprehensive claim than a $20,000 collision claim. Because the average claim is lower, the insurance company's risk is lower. And because their risk is lower, the discount they offer you for a higher deductible is tiny. Let's look at Sarah's quote again. We already established that raising her collision deductible from $500 to $1,000 saves her $35 a month. But what about comprehensive? When she toggles her comprehensive deductible from $500 to $1,000, her premium only goes down by $5. $5 a month. That's $60 a year. Think about that trade-off. She would be taking on an additional $500 of risk to save a measly $60 a year. It would take her more than 8 years without a claim just to break even on that gamble. 8 years. In that time, how likely is it that a rock will crack your windshield? Or that a shopping cart will roll into your door in a windy parking lot? It's almost a certainty. For comprehensive coverage, the math just doesn't make sense. You're taking on a huge amount of risk for a laughably small reward. So Sarah has her answer. She's going to use a split deductible strategy. She'll set her collision deductible high at $1,000 because her sleep at night number allows it and the premium savings are massive. She's making a smart bet on her own driving. But she'll set her comprehensive deductible low at $500 because the risk of random, smaller claims is high and the savings for a higher deductible are practically worthless. This is the optimal strategy for most people with a relatively new car and a decent emergency fund. A high collision deductible and a low comprehensive deductible. But I said new car for a reason. What if you're not driving a brand new SUV? What if you're driving an older car? Let's say Sarah's old car was a 10-year-old sedan, worth about $6,000. How does that change the equation? This introduces our second critical concept, the car's value rule. An insurance company will never pay more to fix your car than what it's worth. If you have a $6,000 car and you get into an accident that causes $8,000 of damage, they won't pay the $8,000. They will declare the car a total loss and write you a check for its value, minus your deductible. So, if Sarah had that $6,000 car with a $1,000 collision deductible, the most she could ever get from her insurance company is $5,000. Her $1,000 deductible represents a huge chunk, 1/6, of her car's total value. She is paying a premium every month for a policy that can, at its absolute best, pay out only $5,000. As a car gets older and its value drops, keeping a high deductible becomes less and less logical. At some point, the car's value drops so low, say to $3,000 or $4,000, that it might not even be worth paying for collision and comprehensive coverage at all. You could be paying hundreds of dollars a year to protect a potential payout of just a couple $1,000s. You might be better off saving that premium money and just accepting the risk of replacing the car yourself if something happens. So for Sarah and her new SUV, the split deductible of $1,000 for collision and $500 for comprehensive is perfect. But if she were insuring her old clunker, a single low $500 deductible for both might have been the smarter move, just to maximize the potential payout relative to the car's low value. This framework, using your sleep at night number and the car's value rule, is the key to finally solving the deductible dilemma. But there's a lurking variable we haven't talked about. What about that single most common claim of all? The one that happens to millions of drivers every single year. A rock flying up on the highway and cracking your windshield. Does that fall under your comprehensive deductible? Do you really have to pay $500 out of pocket for a simple glass repair? The answer is, it's complicated, and many insurance policies have a secret, hidden deductible that applies only to glass, and knowing about it can save you a fortune. Let's peel back the curtain on this so-called secret glass deductible. For most people, your windshield, your side windows, your rear window, they're all covered under your comprehensive coverage. That's the part of your policy that handles things like theft, fire, vandalism, and falling objects, like a piece of gravel kicked up by a truck on the freeway. So, if you have a $500 comprehensive deductible, and that little rock chip turns into a giant crack that's going to cost $400 to fix, you're out of luck. The repair cost is less than your deductible, so you're paying the entire $400 yourself. If the windshield is a fancy new one with sensors and costs $800, you'll pay your $500 deductible, and the insurance company will finally step in and pay the remaining $300. That's the standard, and frankly, it's not a great deal for you. But many top-tier insurance companies offer something called a separate glass deductible, or sometimes it's bundled as full glass coverage. This is an optional add-on to your policy, and it is, without a doubt, one of the best-kept secrets in the insurance world. For a few extra dollars a month, sometimes as little as the price of a cup of coffee, you can set a glass deductible that is completely separate and much, much lower than your main comprehensive deductible. You might have a $100 glass deductible, a $50 one, or even a $0 deductible. Imagine this scenario. You're driving to work, a dump truck merges ahead of you, a stone flies out, and bam! A star-shaped chip right in your line of sight. With your standard $500 deductible, you'd probably just live with it, watching it spread into a giant crack over the next few months, because paying for a new windshield out of pocket is a painful expense. But if you had that $0 glass deductible, you'd make a quick call, a technician would come to your office or home, and they would either repair the chip for free or replace the entire windshield, and you wouldn't pay a single penny. Feels like magic. Now, why would insurance companies even offer this? Are they just being nice? Not exactly. They're being smart. They know that a tiny $20 chip repair today prevents a massive $800 windshield replacement claim tomorrow. By making it free or extremely cheap for you to fix small problems immediately, they save themselves a huge amount of money in the long run. It's a win-win. And here's a pro tip that could be worth hundreds of dollars depending on where you live. In certain states in the USA, this isn't just an option, it's the law. States like Florida, Kentucky, and South Carolina have laws on the books that mandate insurance companies to waive the deductible for windshield repairs or replacements. They're often called zero-deductible states for glass. In Arizona and Massachusetts, you can buy a specific policy rider for a zero-deductible option. So if you live in one of these states and you have comprehensive coverage, you may already have this benefit and not even know it. Check your policy. Call your agent. You could be driving around with a cracked windshield, thinking you can't afford to fix it, when you're already covered for a brand new one, completely free of charge. But glass is just the beginning. This idea of special rules for specific parts of your car opens up a whole new level of understanding your policy. Let's talk about a situation that makes car enthusiasts and people who just bought a new car absolutely cringe. Let's talk about parts. Original parts. Imagine you get into a minor fender bender. Not your fault, but the front bumper and a headlight on your brand new car are smashed. You take it to the body shop, the claim is approved, and you get it back a week later. It looks okay. The paint color is almost a perfect match, but in the right sunlight, you can tell it's just a little bit off. The gap between the new bumper and the hood is just a millimeter wider than it was on the other side. It's subtle, but you see it every single time you walk up to your car. What happened? Your insurance company, in an effort to save money, likely paid for what are called aftermarket parts. These are not parts made by your car's manufacturer. They're generic copies made by a third-party company. Sometimes they're fine. Other times they don't fit perfectly, they're made of lower quality materials, and they can actually decrease the resale value of your vehicle. The insurance company's contract, that policy you signed, usually gives them the right to use parts of like kind and quality, which is a vague phrase that they interpret to mean cheaper, aftermarket parts. This is where another little-known policy option comes in. An OEM endorsement. OEM stands for Original Equipment Manufacturer. This is an add-on, a rider to your policy, that guarantees in the event of a covered repair, the shop must use brand new parts straight from the original carmaker. No knockoffs, no used parts from a junkyard, no questions asked. You get the exact same quality of part that was on your car when it rolled off the assembly line. Is it more expensive? Yes, a little. Adding an OEM endorsement might increase your premium by a small percentage. But if you have a car that's less than 3 or 4 years old, a luxury vehicle, or a classic car you're restoring, this endorsement is non-negotiable. It protects your car's value, its integrity, and its safety, as manufacturer parts are designed to work perfectly with your car's specific safety systems. When you file that claim, your standard collision or comprehensive deductible will still apply, but you won't have to argue with an adjuster about part quality. You're guaranteed the best. This theme continues when we talk about customization. Let's say you're really into your car. You've spent $5,000 on a beautiful set of custom wheels and tires. You installed a $2,000 state-of-the-art sound system with a subwoofer that shakes the block. You even got a custom vinyl wrap that makes your car one of a kind. It's your pride and joy. Then the worst happens. Your car is stolen and never recovered. You file a claim with your insurance. You submit the police report, and the insurance adjuster comes back with an offer. They'll pay you the value of a stock version of your car. They tell you those $5,000 rims? Not covered. That $2,000 stereo? They'll give you $200, the value of the factory radio. That custom wrap? Zero. In an instant, you're out thousands and thousands of dollars, and there's nothing you can do about it. Why? Because a standard auto policy is only designed to cover the car as it was built by the manufacturer. All of your expensive additions are simply not included. The solution is something called Custom Parts and Equipment Coverage, or CPE. This is yet another endorsement you can add to your policy. It specifically covers all of those aftermarket modifications. You typically buy it in increments, say up to $5,000 in coverage or $10,000. You'll need to provide receipts and photos to prove you own the equipment and what it's worth. But if your car is ever stolen or damaged in an accident, the value of those custom parts is protected. So, you see, a deductible isn't just one number. It's part of a complex system. You might have a $500 comprehensive deductible, but a $0 glass deductible. You might have a $1,000 collision deductible, but an OEM endorsement that guarantees the quality of the parts you get. You might have a policy that protects your car, and a separate CPE rider that protects the thousands you've invested in it. Your insurance policy isn't a single blanket. It's a patchwork quilt, and you need to know what every single patch covers. So you've done your homework. You've picked your deductibles. You've added full glass coverage and an OEM endorsement. You feel protected. You feel smart. But then you're sitting at a red light, and you hear the screech of tires behind you. Someone plows into your back bumper. It's clearly 100% their fault. So you don't have to worry about your deductible, right? The other guy's insurance will handle everything. But what if they don't have insurance? What if their coverage is terrible and their company drags its feet for months? Do you still have to pay your deductible to get your own car fixed, even when the accident wasn't your fault? This is where the system gets truly frustrating, and where knowing the right steps to take can be the difference between a smooth repair and a year-long financial nightmare. And we're going to unravel that exact scenario in the next part. So let's paint a picture. You're stopped at a red light, listening to your favorite podcast, maybe thinking about what to make for dinner. The light turns green. The car in front of you moves, you take your foot off the brake, and then, wham! A jarring, violent jolt from behind. Your head snaps back, your heart skyrockets into your throat, and the sound of crunching metal and shattering glass fills the air. You've just been rear-ended. After the initial shock wears off, you do all the right things. You check to see if you're okay. You put your hazards on. You get out, exchange information with the other driver who, thankfully, is also okay and seems very apologetic. He admits it was totally his fault. He was looking down at his phone for just a second. You take pictures of the scene, the damage to both cars, his license plate, his driver's license, and his insurance card. The police arrive, they take a report, and they officially cite the other driver as being at fault. In a perfect world, the story ends there. You call the phone number on the other driver's insurance card. You give them the claim number. They say, yes, our driver was 100% at fault. We accept full liability. They arrange for a rental car for you. They send an adjuster to look at your car. And they write you a check for the full cost of the repairs. You take your car to the shop, it gets fixed, and you pick it up a week later good as new. In this perfect scenario, your deductible never even enters the conversation. You don't pay a single penny out of your own pocket because your insurance company wasn't involved. The at-fault party's insurance covered everything. Simple, clean, easy. But we don't live in a perfect world. The reality of this exact situation can be a minefield of delays, disputes, and downright deception that leaves you, the innocent victim, stuck with a wrecked car and a giant headache. Let's rewind to the scene of the accident. What if the other driver gives you an insurance card that's expired? Or worse, it's completely fake. What if he has no insurance at all? Right there, the perfect world scenario evaporates. Now you're dealing with an uninsured motorist. Or let's say his insurance is valid. You call his company to file the claim, and the agent on the other end says, well, we need to conduct a full investigation. We haven't been able to get a statement from our insured yet. So you wait. A day goes by, then 3 days, a week. Your car is sitting in a tow yard, racking up storage fees, or it's barely drivable, and you're trying to get to work. You call them again. Sorry, they say, we're still trying to reach our driver. We can't move forward until we speak with him, and he confirms the details of the accident. This is the delay game, and some insurance companies are masters at it. They know that every day they delay is a day they hold on to their money. They have no legal obligation to hurry up for your convenience. You are not their customer. Their only obligation is to their own shareholder value and to their own client. But here's where it gets even more infuriating. What if their driver, the one who was so apologetic at the scene, decides to change his story? He tells his insurance company that you suddenly slammed on your brakes for no reason at a green light, causing the accident. Now it's a word against word dispute. Even with a police report in your favor, his insurance company can, and often will, use his statement to argue about liability. They might say, okay, we'll accept 80% of the fault, but we believe your driving contributed 20%. This means they'll only offer to pay for 80% of your repairs, leaving you to figure out the rest. In any of these frustrating scenarios, the uninsured driver, the delay game, or the liability dispute, you are stuck. Your car is damaged, you need it fixed, and the other person's insurance is either non-existent or giving you a massive runaround. So what do? This is the critical moment of decision, and this is where your own insurance policy and your own deductible becomes your most powerful tool. You have a choice. Option A is to wait. You can wait for the other insurance company to finish their investigation. You can wait for them to finally get a hold of their driver. You can try to fight their ridiculous 80-20 liability decision. This could take weeks or even months. All the while you're without a car, or you're paying for a rental car entirely out of your own pocket, hoping you'll get reimbursed later. Or there's option B. You decide you're not going to be a hostage to another company's incompetence or strategy. You call your own insurance company. You tell them, I was in a not-at-fault accident, and the other party's insurance is being difficult. I want to use my own collision coverage to fix my car now. And your insurance company will say, absolutely. We can do that. They'll get the process started immediately. They'll have an adjuster look at your car within days. They'll approve the repairs. You can take your car to the shop tomorrow. There's just one catch. You have to pay your deductible. This is the part that feels incredibly unfair. Why should you have to pay $500, $1,000, or even $2,000 out of pocket for an accident that was clearly not your fault? It feels like a penalty for being in the wrong place at the wrong time. And this feeling, this hesitation, is what stops many people from taking action. They don't want to pay that deductible on principle. But here is the secret. Paying your deductible in this situation is not a penalty. It's an advance. It's a key that unlocks the immediate repair of your vehicle. And you are very, very likely to get that money back. This brings us to one of the most important and least understood words in the insurance world: subrogation. Subrogation is a legal term, but what it means is simple. Your insurance company has the right to step into your shoes and legally pursue the at-fault party to recover the money they paid out for your claim. This includes the money they paid to the body shop, and most importantly, the deductible that you paid out of your pocket. Think of it this way. When you use your own collision coverage, you are essentially fronting your deductible to your insurance company. In exchange, they immediately pay the thousands of dollars to get your car fixed. Then, their legal and collections department goes to war on your behalf. They contact the other driver's insurance company and demand full reimbursement for everything they paid. They have entire teams of people who do nothing but this all day, every day. They are far better equipped to fight this battle than you are. When they are successful in recovering the money from the other insurance company, a process which can take several months, the very first thing they are legally required to do is reimburse you for the deductible you paid. So, you get a surprise check in the mail for $1,000, making you whole again. This subrogation process is the safety net that protects you from the nightmare scenarios. It empowers you. It means you don't have to wait for a slow, uncooperative insurance company. You can take control. You can get your car fixed, get your life back to normal, and let your insurance company handle the fight in the background. You pay your deductible up front, yes, but it's a temporary cost to get an immediate solution. Of course, this raises some critical questions. What happens if subrogation fails? What if the other driver truly was uninsured and has no money to their name? Do you just lose your deductible forever? And even if you get your deductible back, what does filing this claim do to your own insurance rates? Won't making a claim, even a not-at-fault one, cause your premium to skyrocket, costing you far more than the deductible in the long run? That fear of a rate hike is a powerful one, and it's exactly what we need to break down next. It's the question that paralyzes drivers, the silent calculation happening in your head as you stand on the side of the road, looking at a dented bumper. The fear isn't just about the immediate cost of your deductible. It's about the ghost of future payments. It's the belief that your insurance company, the one you've paid faithfully every month, is just waiting for you to make one tiny mistake so they can jack up your rates for years to come. This fear is so potent that it causes millions of people to pay for repairs out of pocket, even when those repairs cost significantly more than their deductible. They're essentially paying for insurance they're afraid to use. Let's dismantle this fear piece by piece, because while it's rooted in a speck of truth, it's often magnified into a monster that costs you more money than it saves. The first thing to understand is that a rate increase is not a punishment. It's a business decision. Your insurance premium is, at its core, the price a company charges you to take on your financial risk. When you file a claim, especially an at-fault claim, you are providing them with new data. That data suggests your risk profile has changed. You've gone from a theoretical risk to a demonstrated one. Their response, raising your premium, is simply them adjusting the price to match this new, higher perceived level of risk. It feels personal, but it's purely statistical. So will your rate go up? The honest but frustrating answer is, it depends. But it doesn't depend on magic or the mood of an underwriter. It depends on a few very specific, predictable factors. And the number one, most important factor, the one that outweighs almost everything else, is fault. Were you at fault for the accident? If you rear-ended someone, ran a stop sign, or lost control on a patch of ice and hit a telephone pole, the answer is almost certainly yes. In this scenario, an at-fault accident, you should brace for a rate increase. How much? Industry averages suggest a first-time at-fault accident can raise your rates anywhere from 30 to 50%. That sounds terrifying, but let's put it in context. If your 6-month premium is $800, a 40% increase would be $320, making your new premium $1,120. This increase typically stays on your record for 3 to 5 years, depending on your state and insurer. So, over 3 years, that one accident could cost you an extra $1,920 in premiums. This is the number you must weigh against your deductible. Now let's flip the coin. What if the accident was not your fault? Someone else runs a red light and plows into your driver's side door. They are 100% at fault, and their insurance company accepts liability. In an ideal world, and in most states, filing this type of claim should not increase your rates. You didn't do anything wrong. Your risk profile hasn't changed. You were just in the wrong place at the wrong time. Your insurance company will typically recover the money they pay out to you directly from the at-fault driver's insurance company through a process called subrogation. Since they get their money back, they have no statistical reason to charge you more. But we don't live in an ideal world. What if it's a hit and run? Someone smashes your car in a parking lot and vanishes. Or what if the person who hit you is uninsured or underinsured? In these cases, you're not at fault, but there's no other insurance company to go after. You have to file a claim under your own collision coverage or your uninsured motorist property damage coverage. Because your insurer has to foot the entire bill without getting reimbursed, some companies in some states might enact a small rate increase. It's far less common and far less severe than an at-fault increase, but it's a possibility you need to be aware of. The fear of a rate hike is most valid when you are the one who caused the damage. The second major factor is your history. Are you a long-time customer with a spotless 15-year driving record? Or is this your second claim in 18 months? Insurance companies live and breathe data. To them, one accident can be an anomaly, a fluke. 2 or more accidents in a short period of time looks like a pattern. It signals a trend of risky behavior. A driver with a single fender bender after a decade of safe driving is a much better bet than a driver who seems to be a magnet for trouble. So if your record is clean, any potential rate increase will likely be less severe. If your record is already spotty, another claim can hit your premium much harder. Third, there's the severity of the claim. There is a world of difference between a $2,000 claim for a cracked bumper and a $75,000 claim for a totaled vehicle, medical payments, and liability payouts. While your company might overlook a very small at-fault claim, especially if you have a good record, a massive payout is a giant red flag in their risk assessment models. It shows that when you do have an accident, it's a catastrophic one. A larger claim is more likely to trigger a significant and lasting premium increase. This brings us to a feature you may have heard of, or even have on your policy right now: accident forgiveness. This is a perfect example of paying a little more now to save a lot later. Accident forgiveness is an optional add-on to your policy that, just as the name implies, means your insurer agrees to forgive your first at-fault accident. They won't raise your rates. Usually, you have to qualify for it by maintaining a clean driving record for a certain number of years, typically 3 to 5. It's the insurance company's way of rewarding safe, loyal customers. If you have accident forgiveness, the entire debate of whether to file a claim changes dramatically. The fear of that rate hike is taken off the table, making it a much simpler decision. So let's bring this all together with a practical, real-world calculation. Imagine you're in a minor at-fault fender bender. You get a quote from a body shop. The damage is $1,800. Your collision deductible is $500. If you file the claim, you pay $500 and the insurance company pays the remaining $1,300. Your immediate out-of-pocket savings is $1,300. But you don't have accident forgiveness, and this is your first at-fault claim. Let's assume your premium is $150 a month, or $1,800 a year. A 40% rate increase would be $60 per month. That's an extra $720 per year. And that increase will likely stick around for 3 years. So, $720 times 3 years is $2,160. Now look at your choice. Option A: file the claim. You save $1,300 today, but you will pay an extra $2,160 in premiums over the next 3 years. Your net loss is $860. Option B: don't file the claim. You pay the full $1,800 for the repair out of pocket today. Your premium remains unchanged. In this very realistic scenario, eating the entire cost of the repair yourself is actually over $800 cheaper in the long run. This is the math that every driver should be doing. It's the calculation that separates the fear from the finance. The decision to file a claim isn't about pride or avoiding a hassle. It is a business decision about your financial future. You have to weigh the immediate savings of using your insurance against the potential long-term cost of a higher premium. If you are not at fault, it almost always makes sense to file. If you have accident forgiveness, it almost always makes sense to file. But if you are at fault and you don't have forgiveness, you need to get a repair estimate first. If the repair cost is only a few $100s more than your deductible, paying out of pocket is often the smarter financial move. This deep understanding of the consequences of a claim completely changes how we should view our deductible in the first place. It's not just a simple barrier to getting a repair paid for. It's a strategic tool. Knowing all this, knowing how a claim can impact your rates, how do you intelligently choose your deductible amount when you first buy your policy? How do you decide between that low, tempting $250 deductible and a much higher, premium-saving $1,000 or even $2,000 deductible? What's the secret break-even point? And how do you find the number that's perfectly tailored to your personal financial situation and your tolerance for risk? Let's break this down with a tale of two drivers. We'll call them low-deductible Laura and high-deductible Harry. They live in the same town, drive similar cars, and have identical driving records. The only difference is their philosophy on insurance. Laura values predictability above all else. The thought of a sudden, large, unexpected bill sends a shiver down her spine. She wants to know that if something happens, her out-of-pocket cost will be minimal and manageable. So Laura chooses a very low $250 deductible for both her collision and comprehensive coverage. Because she's asking the insurance company to take on more risk, her premium is higher. Let's say she pays $180 per month for her policy. That's $2,160 a year. It's a significant line item in her budget, but for her, it's the price of peace of mind. Now let's look at Harry. Harry is a numbers guy. He sees that high monthly premium and thinks, that's a guaranteed loss. I'm paying that money whether I have an accident or not. I'd rather bet on myself. He's comfortable with a bit more risk, especially if it means more cash in his pocket every month. So, Harry opts for a much higher $1,500 deductible. Because he's telling the insurance company, don't worry about the small stuff, I'll handle it. They reward him with a much lower premium. His monthly bill is only $120. That's $1,440 a year. Right off the bat, Harry is saving $60 a month, or a whopping $720 every single year compared to Laura. For a couple of years, everything is smooth sailing. Harry takes that $720 he saves each year and puts it straight into a high-yield savings account he's labeled Car Emergency Fund. After 2 years, he's saved $1,440. Plus a little interest. He's feeling pretty smart. Laura, meanwhile, has paid over $4,000 in premiums, but she slept soundly every night knowing she's covered. Then one icy Tuesday morning it happens. Both Laura and Harry, in separate incidents, slide on a patch of black ice and hit a guardrail. The damage to each of their cars is identical. A crumpled fender, a broken headlight, and a nasty scratch down the side. The body shop quotes them both the exact same repair cost, $3,000. Now the moment of truth. Laura calls her insurance company. The adjuster confirms the damage, and the process is simple. The total repair is $3,000. She has her $250 deductible. She writes a check to the body shop for $250, and her insurance company pays the remaining $2,750. It's a hassle, sure, but it's not a financial catastrophe. The system worked exactly as she paid for it to. Harry also calls his insurance company. The process is the same, but the numbers are starkly different. The repair is $3,000. He has his $1,500 deductible. He has to write a check to the body shop for $1,500. His insurance company covers the other half. Now remember that car emergency fund? He's got $1,440 in it. He has to pull all of that out and still find another $60 from his regular checking account to cover the bill. His savings for this exact purpose are wiped out. It's a painful hit. So, who made the smarter choice? At first glance, you might say Laura. She only had to pay $250, while Harry was at $1,500. But that's not the full picture. We have to do the math. We have to find the break-even point. Here's the secret formula. The back-of-the-napkin calculation you need to do for yourself. First, find the difference in the annual premium. In our story, Harry saves $720 per year compared to Laura. Second, find the difference in the deductible amount. Harry's deductible is $1,500 and Laura's is $250. The difference is $1,250. Now divide the difference in the deductible by the annual premium savings. So $1,250 divided by $720. The answer is approximately 1.73. What does that number mean? It means it would take Harry 1.73 years of being accident-free for his premium savings to completely cover the extra cost of his higher deductible. Let's call it 21 months. Since Harry's accident happened 2 years in, that's 24 months, he was already past the break-even point. Yes, he had to pay out a big chunk of cash. But over those 2 years, he had already saved $1,440 in premiums that Laura had paid and would never see again. His net cost for this incident, when you factor in his savings, was really only $60. Laura, on the other hand, paid her $250 deductible plus the $1,440 in extra premiums over those 2 years that Harry didn't. Her total cost for that peace of mind was nearly $1,700. In this specific scenario, Harry, the high deductible driver, came out financially ahead, even though he had an accident. This break-even calculation is the single most important tool you have for choosing your deductible. Ask your insurance agent for quotes at different deductible levels: $250, $500, $1,000, $1,500, even $2,000. Then run this simple calculation. You might be shocked to find that the break-even point for a $1,000 deductible is less than 2 years. If you're a safe driver and you believe you can go 2 years without causing an accident, the higher deductible is mathematically the smarter bet. But, and this is the most important, but in this entire video, this strategy only works under one non-negotiable condition. You must have the full deductible amount saved and easily accessible. A high deductible is not a way to get cheap insurance if you're broke. It's a calculated financial strategy for people who can self-insure for smaller claims. Choosing a $1,500 deductible when you don't have $1,500 in the bank is not a risk. It's a guaranteed financial disaster waiting to happen. If an accident occurs, you won't be able to pay the body shop to get your car back, and you might be forced into taking on high-interest debt to cover it, completely wiping out any savings you made on premiums. So the first question isn't, what's the break-even point? The first question is, what is the absolute maximum amount of money I could comfortably pay out of pocket tomorrow without derailing my life? That amount is your absolute maximum deductible. Don't even consider a number higher than that. For many people, that number is $500 or $1,000, and that's perfectly fine. Choose the highest deductible you can comfortably afford to pay, and then use the break-even calculation to see if it makes mathematical sense. There's another, more subtle benefit to a higher deductible. Changes your behavior. Let's say you get a minor parking lot door ding that's going to cost $800 to fix. If you have a $250 deductible like Laura, you're probably going to file a claim. It makes sense. You pay $250, insurance pays $550. But now you have a claim on your record, which could raise your rates at your next renewal. If you're Harry with his $1,500 deductible, filing a claim for an $800 repair is not even an option. The cost is below your deductible, so insurance won't pay a dime. You're forced to either pay for it yourself or simply live with the cosmetic damage. This acts as a natural deterrent against filing small nuisance claims. Over the long run, having a cleaner claims history is one of the best ways to keep your insurance rates low. By choosing a higher deductible, you are essentially pre-committing to only using your insurance for what it was truly designed for: major financially significant events. So the choice between low and high is a deeply personal tug-of-war between guaranteed monthly costs and potential future costs. It's a balance of your cash flow, your savings, your driving habits, and your personal tolerance for risk. There is no single right answer, only the right answer for you. But now you have the formula to find it. We've been focusing entirely on collision, the damage to your own car when you cause an accident. But what happens if the accident isn't your fault? Or what if your car is damaged by something else entirely, like a hailstorm, a fire, or a falling tree? This is where your comprehensive deductible comes into play, and its rules can be surprisingly different. And what about the other driver's insurance? How does that affect whether you have to pay your deductible at all? Let's start with that comprehensive deductible. This is the part of your policy that covers damage to your car from things other than a collision. Think of it as the life happens coverage, and the scenarios it covers can be wild. Imagine you wake up one morning, ready to take on the day, and you find a massive oak branch has decided to re-landscape the roof of your car during an overnight storm. Or you come out of the grocery store to find a shopping cart, propelled by a gust of wind, has left a deep, personal-looking scratch all the way down the passenger side door. Or even worse, you walk out to the spot where you parked your car, and there's just an empty space. It's been stolen. These are all comprehensive claims. Vandalism, fire, flood, hail, hitting a deer. These are not collisions with another vehicle, so they fall under this unique umbrella. And just like with collision coverage, you have a deductible. If that tree branch caused $4,000 in damage and your comprehensive deductible is $500, you pay the $500, and your insurance covers the remaining $3,500. But here's where those surprisingly different rules come in. Many people don't realize this, but comprehensive deductibles are often treated differently than collision deductibles, especially when it comes to glass. Have you ever been driving down the highway and a rock flies up from the truck in front of you, hitting your windshield and creating that perfect, star-shaped crack that seems to grow an inch every day? That is a comprehensive claim. And because this is so common, and because driving with a cracked windshield is a safety hazard, many insurance companies and state laws have special provisions for it. In some states like Florida, Kentucky, and South Carolina, insurers are required by law to waive your comprehensive deductible for windshield replacement or repair. That means you could have a $500 or even $1,000 comprehensive deductible, but if you need a new windshield, you pay zero. Nothing. In other states, it's not a law, but many top-tier insurance companies offer an optional $0 glass deductible or full glass coverage for a very small addition to your premium. We're talking a few dollars a month. It's one of those tiny policy details that can save you hundreds of dollars when that inevitable rock chip happens. It is absolutely worth asking your agent about. Now let's pivot to the biggest, most emotionally charged question of all. The one that causes more confusion and anger than almost any other part of the insurance process. What happens when the accident is 100% undeniably not your fault? Picture this. You're sitting patiently at a red light, listening to your favorite podcast. Suddenly, bam, you're jolted forward as a car slams into your rear bumper. You get out, exchange information, and the other driver is incredibly apologetic. They admit they were looking at their phone and didn't see you stopped. The police report confirms it. You are 0% at fault. Your car has $3,000 worth of damage. So you call your insurance company ready to get this sorted out. And they tell you, okay, we can get the repair process started right away. You just need to pay your $500 collision deductible. Wait, what? You can feel the frustration bubble up. Why on earth should I have to pay a single penny when their client was the one who caused the entire mess? This feels like a scam. Feels fundamentally unfair. And in that moment, most people think they have two options. Option one is to refuse to pay your deductible on principle. You decide you're going to deal directly with the other person's insurance company. You'll make them pay for everything from day one. In a perfect world, this would work. But this is not a perfect world. The other person's insurance company has no loyalty to you. Their primary goal is to pay out as little as possible for their client's mistake. So they might drag their feet. They'll say they need to conduct a thorough investigation. They need to interview their driver, who suddenly isn't answering their calls. They need to see the police report, which could take a week to become available. They might even try to argue that you stopped too suddenly, trying to assign partial fault. All the while, your car is sitting in a tow yard or your driveway undrivable. Days, maybe even weeks go by. You're stuck paying for a rental car out of pocket, with the hope they'll eventually reimburse you. It's a bureaucratic nightmare. That brings us to option two. The smart option. The one that feels wrong at first but saves you an ocean of time and stress. You use your own insurance. You tell your insurance company, yes, let's proceed. You pay your $500 collision deductible. Why? Because your insurance company does have a loyalty to you. You are their customer. Under the terms of your contract, they are obligated to get your car fixed and get you back on the road as quickly as possible. They arrange for the tow, they work with the body shop you choose, they assess the damage, and they cut a check for the repairs minus your deductible. Your car is in the shop the next day, not sitting around waiting for another company to make a decision. But what about your $500? Is it gone forever? Absolutely not. This is where a critical behind-the-scenes process called subrogation begins. Subrogation is a legal term that basically means to stand in someone else's shoes. Once your insurance company has paid for your repairs, they now have the right to stand in your shoes and go after the party that was actually responsible for the damage. In this case, the at-fault driver and their insurance company. Your insurance company becomes your champion. They take all the evidence, the police report, the photos, the other driver's admission of fault, and they send a bill to the other insurance company. They say, "Our client was not at fault. Your client caused $3,000 in damages. We paid $2,500, and our client paid a $500 deductible. You owe us the full $3,000. Think of it like this. Your insurance company has a team of lawyers and professionals who do this all day, every day. They are experts at recovering money from other insurance companies. They will fight on your behalf so you don't have to. While you're back on the road driving your newly repaired car, your insurance company is handling all the nasty phone calls and paperwork. And when they successfully recover the money from the other insurer, which they will, in a clear-cut case like this, two things happen. First, they get their $2,500 back. Second, and most importantly for you, they get your $500 back. They will then issue you a check for the full amount of your deductible. So, in the end, you are made whole. You paid nothing out of pocket for an accident you didn't cause. The only difference is you chose the path that got your car fixed in days instead of weeks or months. Paying your deductible in a not-at-fault accident isn't an admission of guilt. It's not a penalty. It is simply the fastest, most efficient way to trigger your own coverage and get your life back to normal, with the full expectation of being reimbursed once the insurance companies settle the score. Of course, this raises another terrifying question. What if the person who hits you doesn't have insurance at all? Or what if they have the bare minimum coverage that isn't enough to pay for your repairs? This is where your uninsured or underinsured motorist coverage kicks in. And yes, that coverage can sometimes have its own separate deductible. But what if the fault is shared? What if it's a messy situation in a parking lot where you were both backing out at the same time? A 50-50 fault scenario? And how do entire states with no-fault insurance laws completely change the game of who pays what and when? The answer to that could save you thousands of dollars and a monumental headache, and it completely rewrites the rules of subrogation we just discussed. So, how can entire states with no-fault insurance laws completely change the game of who pays what and when? The answer to that could save you thousands of dollars and a monumental headache, and it completely rewrites the rules of subrogation we just discussed. Imagine for a moment that everything we've talked about, the blame game, proving the other driver was at fault, waiting for their insurance to pay, is just one way of doing things. It's called a tort system, or more simply, an at-fault system. But about a dozen states in the US decided this system was inefficient. It was clogging up the courts with lawsuits over minor fender benders and taking forever to get injured people the medical care they needed. So they created a different path, the no-fault system. And the core idea is deceptively simple. In a no-fault state, if you're injured in a car accident, you don't turn to the other driver's insurance to pay your medical bills. You turn to your own. It doesn't matter if you were rear-ended while stopped at a red light, or if you accidentally caused the crash yourself. For your own injuries, you go through your own policy first. The concept of fault is temporarily taken off the table for the initial medical claims. This is designed for one primary reason: speed. It gets you money for your doctor's bills and lost wages quickly, without having to wait weeks or months for investigators to decide who was to blame. The engine that makes this entire system run is a specific type of coverage called personal injury protection, or PIP. In no-fault states, carrying PIP coverage is mandatory. Think of it as a dedicated health insurance fund specifically for car accident injuries. It covers things like your medical bills, ambulance rides, rehabilitation costs, and even a portion of your lost income if the injuries prevent you from working. It can even cover things like hiring someone to do household chores you can no longer perform. Now, here's where it connects directly back to your wallet and your deductible. Your personal injury protection coverage often has its own, separate deductible. This is a critical piece of information that most people in no-fault states miss. They think their deductible only applies to fixing their car. But if you're in an accident in, say, Florida or New York, and you have a $500 PIP deductible, you are responsible for paying that first $500 of your own medical expenses out of pocket before your own PIP coverage begins to pay. Let's make that real. You're in a no-fault state. Someone runs a stop sign and T-bones you. You have to go to the emergency room and the bill is $3,000. You have a PIP policy with a $500 deductible. You file a claim with your own insurance company. You pay the first $500. Your insurer then pays the remaining $2,500. Notice who we haven't mentioned yet? The other driver. For your initial medical treatment, they are completely out of the picture. And because your own insurance is paying for your own injuries, there is no subrogation for this part of the claim. Your insurance company can't go after the at-fault driver's insurance to get that $2,500 back. It's simply the cost of doing business in a no-fault state. But this is where the biggest, most common, and most costly misunderstanding about no-fault insurance comes into play. People hear no-fault and assume it applies to everything, including the giant dent in their door. It does not. In almost all no-fault states, the no-fault rule applies only to injuries. When it comes to the damage to your vehicle, the property damage, the system flips right back to a traditional at-fault model. Let's go back to that T-bone accident. For your $3,000 medical bill, you used your own PIP coverage and paid your PIP deductible. But for your $10,000 car repair bill, now fault matters again. The driver who ran the stop sign is considered at fault for the damage to your car. So, you have the same two choices we discussed in the last part. You can either file a claim directly against their property damage liability insurance and wait for them to pay. Or if you want your car fixed faster, you can use your own collision coverage, pay your $1,000 collision deductible, and let your insurance company handle the repairs. And once they've paid that claim, what do? They initiate the subrogation process against the at-fault driver's insurance company to get their money back. And most importantly, to get your $1,000 deductible back for you. So you see the split personality here? In a no-fault state, you live in two different insurance worlds at the same time. For your body, it's a no-fault world. For your car, it's an at-fault world. Your PIP deductible is for your medical bills and is almost never recoverable. Your collision deductible is for your car repairs and is recoverable through subrogation if the other party was at fault. Understanding this single distinction is the key to navigating an accident in states like Michigan, New Jersey, Pennsylvania, or any of the others. Now you might be thinking, so if I get seriously injured by a reckless driver, I can never sue them for my pain and suffering? Not exactly. The no-fault system isn't meant to let truly dangerous drivers off the hook. It's meant to filter out smaller claims. To step outside the no-fault system and sue the other driver for damages beyond what your PIP covers, like pain and suffering, you have to meet a certain threshold. This threshold can be one of two types. The first is a monetary threshold. This means your medical expenses must exceed a certain dollar amount, which varies by state. It could be $2,000, $4,000, or $5,000. Once your bills cross that line, the door opens for you to file a lawsuit against the at-fault driver. The second type is a verbal or serious injury threshold. This is more common. It doesn't care about the dollar amount of your bills. It cares about the severity of your injury. The law will have a specific definition of what counts as serious, such as significant disfigurement, a bone fracture, permanent limitation of a body part, or death. If your injury meets this descriptive definition, you have the right to sue the at-fault driver for pain and suffering. It's also crucial to know that the term no fault isn't one size fits all. The system is a patchwork quilt across the country. There are the true mandatory no-fault states like Florida and Michigan. Then you have choice no-fault states like Kentucky, New Jersey, and Pennsylvania. There you are given a choice when you buy your policy. You can opt into the no-fault system, which limits your right to sue but usually gives you a lower premium, or you can stick with a traditional at-fault tort system, which preserves your right to sue but costs more. Then there are even add-on states, like Maryland and Delaware, which are technically at-fault states but still require drivers to buy some form of personal injury protection for their own initial medical bills. So let's put it all together. If you live in a no-fault state and you're in an accident that wasn't your fault, the path of your money and your deductibles follows two separate streams. Stream 1 is your body. Your injuries are covered by your own PIP policy. You pay your PIP deductible out of pocket, and that money is likely gone for good. Stream 2 is your car. The damage to your vehicle is covered by the at-fault driver's insurance. If you use your own collision coverage to speed things up, you will pay your collision deductible, but you have a very good chance of getting it back through subrogation. It's a complex, hybrid system that rewrites the basic rules of insurance. But now you understand that no fault doesn't mean no one is ever at fault. It just means we settle the medical bills first and ask questions about blame later, and only for the most serious parts of the claim. But this brings us to a terrifying question. We've built this entire understanding on the idea that the other driver, the one who is clearly at fault, has insurance. We've assumed that there is an insurance company on the other side for our subrogation department to pursue. But what happens when that's not true? What happens when the person who hit you has no insurance, or worse, they simply vanish into thin air after the crash? In that scenario, your deductible isn't just a number on a page. It's a ghost, and the hunt to get it back becomes a completely different kind of story. And in this story, you're not just the victim. You become the detective, and your insurance company becomes your partner in a financial manhunt. The case file is open, the subject is your missing deductible, and the prime suspects are the uninsured and the unknown. This isn't just a hypothetical nightmare. It's a stark reality on American roads. The Insurance Research Council estimates that about 1 in 8 drivers in the United States is uninsured. That's nearly 13% of everyone you share the road with. In some states like Mississippi or Florida, that number can skyrocket to over 25%. 1 in 4 cars. Let that sink in. So when that uninsured driver slams into your pristine bumper and offers nothing but a shrug and an empty wallet, who pays for your car? Who pays you back for that $1,000 deductible you have to front to the body shop? The answer lies in a part of your policy that many people overlook, but is arguably one of the most important coverages you can buy. Uninsured and underinsured motorist coverage. Let's call it UM/UIM for short. This isn't just an add-on. It's your financial bodyguard. UM/UIM coverage steps in and plays the role of the at-fault driver's insurance because, well, they don't have any. It's a hero in disguise. It typically comes in 2 main flavors. First, there's uninsured motorist bodily injury, or UMBI. This is the big one. It covers your medical bills, lost wages, and pain and suffering if you or your passengers are injured by an uninsured driver. It's the coverage that prevents a car crash from turning into a life-altering medical debt crisis. But for our story about the ghost deductible, we're focused on the second flavor, uninsured motorist property damage, or UMPD. This is the part of the policy that pays to repair or replace your car. When that uninsured driver hits you, instead of filing a claim against their non-existent policy, you file a claim against your own UMPD coverage. Your insurance company pays for your repairs, and then they take on the often fruitless task of trying to chase down the uninsured driver to get their money back. You get your car fixed and they take on the headache. Now here's the critical question, the one that directly impacts your wallet. Do you still have to pay a deductible on a UMPD claim? The answer is, it depends. This is where knowing your policy and your state's laws becomes a superpower. In many states, UMPD coverage comes with its own, separate deductible, which is often much lower than your standard collision deductible. For example, in a state like California, the standard UMPD deductible is often just a few $100s, a fraction of a typical collision deductible. Some policies in other states might have no deductible at all for this specific coverage. This is a massive win. You get hit by someone breaking the law, and your insurance rewards you with a smaller financial hurdle to get your car back on the road. But what about the most frustrating scenario of all? The hit and run. A phantom car sideswipes you on the highway and vanishes into the night. There's no one to exchange information with, no one to hold accountable. This is where UMPD truly shines, but it comes with a condition, a non-negotiable rule of the game. You must prove the other driver exists. You can't just claim a hit and run for a dent you found in the parking lot. This means your first call, even before your insurance agent, should be to the police. A police report is your golden ticket. It's the official document that says, yes, an accident with an unidentified vehicle occurred. Without it, your insurance company has no way of knowing you didn't just accidentally back into a telephone pole. The second thing you need is evidence. If there were witnesses, get their contact information. If you manage to catch even a partial license plate number, write it down. Take photos of the damage and the scene immediately. You are building a case, and your UMPD coverage is the law firm that's going to represent you. Now let's explore the dark side. What happens if you decline this coverage? You looked at your policy options, saw uninsured motorist coverage, and thought, I'll save a few bucks a month and skip it. In that moment of decision, you unknowingly took on a massive financial risk. If you are hit by an uninsured driver and you don't have UMPD, your only option to get your car repaired through insurance is to use your own collision coverage. And what does that mean? It means you are absolutely 100% on the hook for your full collision deductible. Whether it's $500, $1,000, or $2,000, that money is coming out of your pocket. Even worse, because there's no other insurance company to subrogate against, your insurer has to eat the entire cost of the repair. While most companies won't classify this as a formal at-fault accident that skyrockets your rates, it can still be seen as a negative mark on your record, potentially impacting your premiums at renewal time. You did nothing wrong, yet you pay your deductible and you might see your rates creep up, all because you didn't have that UMPD bodyguard on your policy. This is why insurance professionals are so adamant about this coverage. It's not an upsell. It's a fundamental shield against the irresponsibility of others. The few extra dollars it costs per month is a tiny price to pay to avoid a $1,000 deductible and a potential rate hike for an accident that wasn't even your fault. But let's go one level deeper, into a little-known secret weapon that some insurance companies offer. It's often called a collision deductible waiver, or waiver of deductible. This is a special endorsement you can add to your policy. It's a very specific promise from your insurance company that says, if you are in an accident that is not your fault, and the person who hit you is identified but is uninsured, we will waive your collision deductible entirely. You pay nothing out of pocket to get your car fixed. Zero. Think about the power of that. It completely removes the financial sting of being hit by an uninsured driver. You don't have to worry about a lower UMPD deductible. Your collision deductible simply vanishes for that claim. It's the ultimate peace of mind. Not all companies offer it, and it does cost a little extra, but if it's available, it's one of the best investments you can make in your auto policy. It transforms your deductible from a mandatory expense into a conditional one, a fee you only pay if you are at fault, or if the other driver is a complete ghost. Ultimately, this entire hunt for the ghost deductible brings us back to the central theme of insurance: risk transfer. Every time you get behind the wheel, you accept a certain amount of risk. The risk of an accident, the risk of a breakdown, the risk of a lawsuit. Your deductible is the portion of that risk you agree to keep for yourself. But the risk of another driver being irresponsible and uninsured? That's a risk you don't have to carry alone. UMPD coverage, and especially a collision deductible waiver, are tools for transferring that specific risk back to the insurance company, where it belongs. It's about drawing a line in the sand and declaring that you will not be financially punished for the unlawful actions of a stranger. So we've explored every scenario, from fender benders to phantom drivers. We know what a deductible is, how it works, and how to protect ourselves from the financial fallout when things go wrong. But there's one final critical question that pulls all of this together. How do you choose the perfect deductible for you? Not for your neighbor, not for your financial advisor, but the number that perfectly balances risk and reward for your life, your car, and your bank account. That's the final piece of the puzzle, and it's where the real power lies. So let's find it. Right now, let's build your perfect deductible from the ground up, using 3 critical pillars of your own financial life. This isn't guesswork, it's a formula. And the first, most important, non-negotiable pillar is what I call the sleep at night number. This is the simplest yet most profound test. Your deductible should never, ever be higher than the amount of cash you could pay out right now without causing a major financial disaster in your life. I'm not just talking about having the money in your checking account. I'm talking about being able to write that check for $500, $1,000, $2,000 and still be able to pay your rent, buy groceries, and not have a panic attack. This is your emergency fund test. If you have $1,000 saved for emergencies, a $2,000 deductible is a catastrophic mistake waiting to happen. Because if you get into an accident, you're not just facing a car repair bill. You're facing debt. You're facing the stress of scrambling for cash, putting it on a high-interest credit card, or borrowing from family. That defeats the entire purpose of insurance, which is to provide peace of mind. So the first step is to look at your savings. Be brutally honest with yourself. What is the absolute maximum amount of money you could part with tomorrow without derailing your financial stability? That number is your absolute ceiling. Your deductible cannot be higher than this. Period. If that number is $500, then that's your starting point. Anything higher is a gamble you can't afford to lose. The goal is to pick a number that lets you sleep at night, even if your car is in the shop. Okay, once you have your sleep at night number established as your maximum, we move to the second pillar, the car value reality check. This is where we stop thinking about insurance in a vacuum and start tying it directly to the asset it's protecting, your car. Think about it. Does it make sense to have a $2,000 collision deductible on a car that's only worth $3,000? Absolutely not. In that scenario, you're paying a premium every single month for the privilege of having your insurance company maybe, possibly, give you a check for $1,000 in a total loss scenario. And that's the best case outcome. If you have a fender bender that costs $2,500 to fix, you pay the first $2,000, and the insurance company chips in a mere $500. You've been paying them for years for $500 of help. The math just doesn't work. Here's a powerful rule of thumb. If your deductible is approaching 50% of your car's private sale value, you need to seriously question if you should even have collision and comprehensive coverage at all. At that point, you are effectively self-insuring most of the car's value anyway. You might be better off dropping those coverages, taking the massive savings on your premium, and banking that money yourself into a dedicated car repair or replacement fund. So your second step is to go to a site like Kelley Blue Book or Edmunds. Look up the current private party value of your car. Not the trade-in value, but what you could realistically sell it for yourself. Let's say your car is worth $6,000. Your sleep at night number from Pillar 1 was, say, $1,500.
À $1,500 déductible, on a $6,000 car?
That could be a reasonable risk. But if your car is only worth $4,000, then a $1,500 deductible starts to look a lot less attractive. This reality check helps you dial down from your maximum ceiling to a number that makes sense for the specific vehicle you drive. Now for the third and final pillar, which ties it all together, the personal risk profile. This is where you stop being just a number and start being a person. Insurance companies do this all the time. They assess your risk. Now you're going to do it for yourself with more honesty than they ever could. Ask yourself these questions. How many miles do you drive a year? Someone with a 3-mile commute to work has a fundamentally lower risk of an accident than a traveling salesperson who drives 50,000 miles a year. Where do you park your car? Is it in a locked garage every night? Or is it on a busy city street in an area known for break-ins and hit-and-runs? Parking environment drastically changes your risk for comprehensive claims like theft and vandalism. What's your driving record like? Be honest. Are you the person who has never had a ticket or an accident in 20 years? Or do you have a bit of a lead foot and a couple of fender benders in your past? Do you live in an area with extreme weather? Hailstorms, flooding, hurricanes? These are all comprehensive claim magnets. Are there other drivers on your policy, like a teenager who just got their license? That's a massive risk multiplier. The more yes answers you have to high-risk questions, the more you should lean toward a lower deductible. Why? Because your probability of actually needing to pay that deductible is statistically higher. If you're a low-risk driver in every category, you work from home, park in a garage, have a perfect record, you are the perfect candidate to take on a higher deductible. You're making a calculated bet that you won't need to pay it, and the odds are more in your favor. So let's put it all together in a real-world scenario. Let's invent a driver named Mark. Mark's emergency fund, his sleep at night number, is $2,000. So his absolute maximum deductible is $2,000. Now the car value reality check. Mark drives a 5-year-old SUV worth about $15,000. A $2,000 deductible is only about 13% of the car's value, so it's financially sound. The math works. Finally, the personal risk profile. Mark has a 30-mile commute in heavy traffic every day. He parks in an open parking lot at work. He also has a 17-year-old son on his policy. This is a high-risk profile. So even though Mark could handle a $2,000 deductible, his risk profile screams that he's more likely than the average person to have a claim. For him, the smart move is to dial it back. He decides to choose a $1,000 deductible. It's still a significant number that will give him a good discount on his premium, but it's an amount that won't be financially ruinous when not if a claim happens. He's balancing the premium savings with his real-world risk. This is the final step for you too. Get the actual quotes. Don't guess. Call your agent or use their online portal and ask for the price difference between a $500, a $1,000, and maybe a $1,500 deductible. Let's say going from $500 to $1,000 saves you $30 a month, or $360 a year. Now you can ask the ultimate question. Am I willing to risk an extra $500 out of my own pocket at a moment's notice to save $360 over the course of a year? For some people, that's a fantastic trade. For others, it's a terrible one. But now you have the power to decide. You're no longer just accepting the number on a piece of paper. You're making an informed, strategic financial decision. You've come on an incredible journey. You've gone from perhaps not even knowing where to find your deductible on your policy to understanding how it functions as the very heart of your insurance contract. You've seen how it's not just a random number, but a powerful lever that controls both your monthly expenses and your financial risk in a crisis. You now know more about this single critical number than 95% of the drivers on the road. You have the tools. You have the framework. You have the knowledge to stop letting your insurance policy happen to you, and to start making it work for you. So my challenge to you is this. Don't let this just be another video you watched. Take action. Tonight, find your auto insurance declaration page. Find that number. Look at it. And then run it through the 3 pillars. What's your sleep at night number? What's your car value reality? What's your personal risk profile? Does the number you have right now still make sense? If it doesn't, you know what to do. Tomorrow, make the call. Get the quotes. Adjust the lever. You are now in the driver's seat of your own financial protection. You have the control. Use it.